Consumer use of buy now, pay later continues to grow.
However, consumer advocates warn those small payments can come with big consequences.
According to a 2025 market report, U.S. BNPL users are expected to reach 91.5 million this year.
But will BNPL actually dethrone credit cards?
Breaking down the biggest financial stories shaping America today. This is Fiscal Forge. In 2008, America faced a financial crisis fueled by debt. Today, a new kind of debt is spreading faster than credit cards ever did. And millions of people don't even realize they're trapped. It's called buy now, pay later. Apps like Klarna, Affirm, Afterpay, PayPal Pay in 4 turn debt into entertainment. No waiting, no pain, no guilt. Just tap, buy, and split the payment later.
If you want to buy this pair of Adidas, you can use your credit card or a buy now, pay later service. The result seems similar. You don't pay up front, but with BNPL, you can break that full payment out into installments, usually with no interest.
But here's the disturbing part. Studies now show many BNPL users are already struggling financially, missing payments, using loans for groceries, and stacking multiple installment plans at the same time. Meanwhile, credit card debt in America has crossed historic highs. So the question becomes, which is actually more dangerous? The old school credit card system or the shiny new BNPL economy designed for the TikTok generation? Because one of them may quietly shape the next decade of consumer debt. And the answer isn't what most people think. Credit cards changed consumer behavior forever. Before credit cards became mainstream, people spent money they actually had. Then banks discovered something revolutionary.
Pay later loans are appealing to consumers because they offer accessible, affordable, convenient forms of credit. Their approval rate is around 80% typically for consumers who are requesting these at point of checkout. That's a notably higher approval rate than many traditional credit products.
If consumers could borrow instantly, they would spend far more than cash users ever would. And they were right. According to the Federal Reserve Bank of New York, U.S. credit card debt recently surpassed over $1 trillion. That's not just a statistic. That's millions of households carrying balances month after month, while interest compounds silently in the background. Most people don't realize how dangerous compound interest becomes against them. A small unpaid balance can snowball for years. And banks know this.
But those small payments can pile up fast. Consumer experts say missed deadlines and late fees are the biggest risks, especially when people take out multiple plans at once.
Credit cards are profitable because human beings are emotional spenders. Swipe now, worry later. But then something changed. Young consumers started avoiding credit cards altogether. Not because they hated debt, but because they hated interest. That created an opportunity for Silicon Valley. Buy now, pay later exploded during the pandemic. Online shopping surged.
Buy now, pay later companies took off in the US during the pandemic. Affirm, the only BNPL-focused company that's public in the US, reported its revenue more than doubled over the last 2 years.
Interest rates were low. Consumers wanted flexibility. And fintech companies found the perfect marketing trick. Don't call it debt, call it payments. Instead of, you owe $800, it became only 4 easy payments of $200.
Typically, when people think of buy now, pay later, they think about the pay in 4 model, where you pay a quarter of the price up front, and then you have 3 installments every 2 weeks to pay off the remainder.
Psychologically, that changes everything. Research in behavioral economics shows humans perceive smaller split payments as less painful than paying the full amount up front. And that's exactly why BNPL adoption exploded among younger users.
Buy now, pay later is proving to be especially popular with younger consumers. One survey found that half of those under 40 have used an installment plan.
The younger consumer in particular, shopping online, is looking for alternatives to pay differently. And products like Affirm extend flexible, controllable, and certain financing.
According to consumer studies from financial research firms and surveys discussed across financial media, many BNPL users are under 35 years old.
U.S. malls are making a comeback due in part to a surge in younger shoppers. Nearly 60% of shoppers ages 18 to 34 say they shop at the mall often or sometimes, compared with just 48% of 35 to 54-year-olds. Members of Gen Z, born between 1997 and 2012, are spending money in physical stores at a similar rate to their grandparents.
Some use installment plans for clothing, concert tickets, food delivery, and even groceries. That's where economists started getting nervous. Because historically, when people finance necessities instead of investments, it often signals financial stress underneath the economy.
Buy now, pay later plans are changing consumer spending habits by allowing purchases to be split into short-term, typically interest-free installments, offering an alternative to credit cards.
Here's the real danger. BNPL may not be more dangerous financially, but psychologically, it might be. Credit cards at least feel like debt. There's a card, a limit, an interest rate, a monthly bill. BNPL removes that emotional friction.
Customers pay once a month for a longer period of time instead of every few weeks. There's a simple interest attached to these loans.
No large number, no immediate pain, no intimidating statement, just tiny installments. That creates what behavioral economists call payment decoupling. The brain separates the pleasure of buying from the pain of paying. And once that happens, spending increases dramatically. Some studies have suggested consumers spend significantly more when BNPL options appear during checkout. Think about that. The payment option itself changes human behavior. Not because people became richer, but because the brain became more comfortable with debt, and social media accelerated it even further. Today, shopping is entertainment. Apps are engineered to trigger impulse buying, and BNPL became the perfect fuel for that system. So if consumers are struggling, who benefits? Retailers love BNPL because it increases conversions.
The number of buy now, pay later loans originated in the U.S. by the top 5 lenders grew from 16.8 million in 2019 to 180 million in 2021, a 970% increase. And a recent Lending Tree survey found that nearly half of Americans have used a buy now, pay later service like Affirm or Klarna at least once, including 11% that have used the service at least 6 times.
If a customer hesitates on a $400 purchase, splitting it into smaller payments suddenly feels affordable. That means bigger carts, more impulse purchases, higher spending. Fintech companies profit through merchant fees, late fees, and partnerships.
Rely primarily on fees charged to merchants. Retailers, meanwhile, have increasingly embraced buy now, pay later financing services to boost sales.
Banks profit differently. Credit card companies make enormous money through interest. And during high inflation periods, many consumers carry balances longer than expected. In other words, both systems profit when consumers stay in debt. But there's another layer most people ignore: data. Every transaction teaches companies what you buy when you spend your financial habits, your risk behavior. Modern finance isn't just about lending anymore. It's about behavioral prediction. And that data is worth billions.
So what's behind the rise of buy now, pay later loans? And why are traditional lenders like banks and credit card companies wary of them?
So, which one is worse? Credit cards or BNPL?
Pay later to date represents a giant black hole in the credit profile and their understanding of consumer credit quality.
The answer depends on the user. Credit cards become dangerous when balances compound, interest rates rise. Users make minimum payments only. BNPL becomes dangerous when users stack multiple plans. Spending becomes impulsive. Necessities are financed. Consumers lose track of obligations. Credit cards punish slowly through interest. BNPL encourages overspending silently through psychology. One attacks mathematically, the other attacks behaviorally. And for younger generations, behavior may be the bigger risk, because many users see BNPL as harmless. But debt doesn't become safe just because the app looks friendly, and regulators are paying attention. Governments and financial watchdogs in several countries have already started investigating transparency, hidden risks, consumer protection, debt accumulation.
But broadly, LendingTree found that 41% of BNPL users paid late in the past year, up from 34% a year before. Affirm has reported a decrease in customer defaults.
Because the fear is simple. If an entire generation normalizes micro-debt for everyday purchases, the long-term consequences could reshape consumer finance for decades. But maybe the biggest lesson here isn't about BNPL or credit cards. It's about understanding how modern systems influence human behavior. Most debt today doesn't start with emergency. It starts with convenience, tiny decisions, tiny payments, tiny impulses, repeated thousands of times. And over years, those small habits quietly shape financial futures. Because companies spend billions engineering ways to make spending feel painless.
But President Trump and DOJ have since crippled the Consumer Protection Agency, which announced it would not prioritize enforcing that rule.
But almost nobody teaches people delayed gratification, budgeting, financial psychology, impulse control. And that may be the real financial crisis hiding underneath the economy. Not just debt itself, but the normalization of permanent consumption. The truth is, credit cards are tools. BNPL is also a tool. Neither is automatically evil, but both become dangerous when consumers stop understanding the psychological system behind them. And in a world where every app is competing for your attention, your impulses, and your money, understanding that system may become one of the most valuable financial skills of the next decade. If you enjoyed this breakdown, subscribe to Finance Decoded, because modern finance is changing faster than most people realize, and understanding it early could save you years of financial mistakes.